Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks, 3 charts, and 3 trades for you. Kevin Horner taking us through the charts today. Here to take us through the trades, Jason Brown, stock market expert at thebrownreport.com and the author of 5-Year Millionaire. Great to have you both on. Jason, would love to kick things off on what you're seeing in the market this morning, this week. It's certainly been a busy one.
Hey, good to see you. Glad to be here. And when I look at the overall market, the first thing I think about is warning shots. You got the NASDAQ down 9% from its peak. You had a 1,000-point drop in the Dow Jones Industrial Average yesterday that should have caught everybody's attention with a decisive close very near the bottom. And then the S&P 500 had a breakdown below the 50-day moving average. I'm not trusting today's rebound. I think it fizzles out before the end of the day, but we got a couple more hours to see what happens. I'm not cautiously bullish. I'm slightly bearish. I think there's more to this pullback that's coming.
Okay, maybe not the sentiment I was looking for this morning, but you get what you get. You don't get upset. That's what I always say to my daughter. So let's dive in here. Your first pick in the big three. You've got NVIDIA here. Why NVIDIA?
So I was looking at NVIDIA. Really, when I zoom out, I like to look at the industries, the sectors, and then drill down. First, NVIDIA is part of the Dow, and so the Dow took a big sell-off, and NVIDIA was a little bit of a portion of that. But overall, when I look at the sector, if you look at the SOXL, the semiconductor sector, the chips, memory stocks, they've all been pulling back, and NVIDIA has been no exception. When you zoom out, it's definitely off its highs. And when I think about what's happening with the AI and infrastructure play, yes, it's still in play, but the problem becomes, can NVIDIA outpace the growth that it needs to keep up with its valuation, number one? And then number two, you look at its biggest customers are also starting to become its biggest competitors. You have Amazon starting to build their own Trainium chip. You have Google spending money on developing their own chip. And so when you have major customers that make up a big portion of your sales and revenue, any slight or small change in their spending could affect, I should say, the revenue and the earnings per share. So I don't think NVIDIA is a bad company. I just think it's going to be capped for the time being.
All right. So, Kevin, as we look at the charts for NVIDIA, I look at the chart and I see sort of a different kind of capping in that it's been pretty sideways of late. So take me through the technical picture that you're seeing.
Yeah, I agree, Marley. We've basically gone sideways for 2 months or so, beginning in June, and the range is about that 190 to 215 area. I've got it at a 213 resistance today, which is above the 50-day moving average, I'll note, but it's also the level from which we've been pushed back 2, 3, 4 times now in the last 2 months. So I think that Jason's viewpoint here is certainly appropriate given what we've seen from price level. Now, the timing, of course, of all this is what remains to be seen. But if you're a trader on a daily view, you could certainly justify being at support here right around the 200-day moving average in the vicinity of 190 to 195. Looks like long-range support, but you know, the view here is that it's not currently trending upward, right? I mean, not in the shorter term window. In the longer term window, absolutely. But the range we're seeing may very well present for an opportunity to kind of stay within this sideways range. I mean, we, generally speaking, want to force price to move out of that before we start believing in there being more upside here.
So let's zoom in a little then on this sideways action before we get to Jason's trade, Kevin, and take a closer look at what levels specifically you're honing in on.
Sure thing. So what we're looking at on this intra-period chart, the last 90 days on a 4-hour bar, we still can see the support horizontally, 190, pretty evident. But that overhanging resistance up there around 215 is fairly obvious. It also coincides with the linear regression line of best fit there as well. Sure, we're getting a bullish cross as we speak in the MACD down below, but as Jason pointed out, you know, this is a big move to get to 215 by itself. I mean, that's a 20-point move from here, better than 10%. And to push through 215 would be a pretty good positive, but the odds don't necessarily favor it rallying through 215 aggressively. As we often say, we don't know if it's going to pause at resistance or bust through, but it represents an area where we could see price rallies kind of run their course.
All right, Jason, I have an advanced look at your trade here, so I know that 215 is an important level here. Take us through this example trade.
Yeah, absolutely. And if we go back to November of last year when we pulled back after a big rally, the stock traded sideways for about 6 months. So it didn't break out until April. So again, it could go up, but when you're talking about looking for a breakout, I think we're going to be trapped here, which is why I structured the trade. As a trader, I like to look at this and say, how many ways can I be right? And I think more traders should consider that when it comes to their bank account. What I love is NVIDIA can go up with this trade. It can go sideways. It can go down. We still make money. So I'm looking at buying the 230 out of the money call option. It's going for about $2 and then selling the 220. So the closer to being in the money, even though it's out of the money option for $3, that's going to give you a net credit of $1. So this is a bear call spread. You have 50 days on this. My view on this is I don't see NVIDIA breaking out above 215 in the next 50 days. Even if it does, you have a $5 cushion plus an extra dollar cushion because you took in a dollar credit. But if it just goes sideways and that time runs out, we're risking $10 to make $1, which is a 10% return in 50 days, which is pretty good. And again, the stock could go sideways. It can go down. It even can go up. And you have a high percentage chance of still being right on this trade, which is why I like how it's structured.
All right, and NVIDIA right now up 2% at 193.87. The earnings event, of course, in the time of this trade as well. They're coming up on August 26th for this one. Want to move to your second pick here. We're talking about Home Depot. Facing challenges, acknowledges it's facing challenges, says those challenges aren't going anywhere, underperforming not just the broader market, but also the sector here for this name. So how are you looking at Home Depot, Jason?
Yeah, when I put my common sense hat on for Home Depot, what common sense tells me is that, period, they need housing activity, they need homeowner confidence and accessible financing. And right now, all three of those are working against Home Depot. So when homeowners can't afford to move, they renovate. Or if they are moving, typically they don't like the house that they bought from someone. They want to paint it, do something there that they need to run up to Home Depot for. But if people are, strapped due to inflation, so they're not necessarily renovating their own houses, or B, they're not moving because of high interest rates and they're just kind of staying put, that doesn't create much movement for a Home Depot. You look at the June existing home sales numbers, fell 2.4% from May, and then pending home sales fell 5.4%. And so those numbers are not going in the right direction. I mean, existing homes and the ones pending are both going in the opposite direction. And then I know we're going to look at the chart here in a minute, but from my own analysis, it's been in a downtrend since December. Stock's been trapped by the 200-day moving average. We recently just ran right back up to it this past week. It started to stall and fall out from that level. So I'm bearish on Home Depot. I think it has lower to go.
All right, Kevin. So as you look at the technicals here, is there potential for Home Depot to go even lower?
Yeah, there certainly is. I'm going to agree with Jason. I'm going to go back to September, finding the peak there in the neighborhood of 420 or so in September. And we've been seeing lower highs along the way, lower low created in mid-May. Now, I drew in an inverse head and shoulders that could be bullish if we can get above 360. But you can see the instances of overhanging resistance. Look at the greatly downsloping 200-day. I've called that out with 3 consecutive ovals where Home Depot rallied into the 200 and failed, tried to get through it or tried to test it, couldn't even close above it in these instances except for 1 day. So, the opportunity for the bulls is if they can hold the 50-day moving average around 330, potentially that what I've drawn in as a right shoulder on this inverse head and shoulders, I suppose, that horizontal support, if you will, down there around 320. But you know what? The prevailing trend of downtrend scenario here has to be noted. And if you're looking for a reversal, the first thing we got to do is take out one level of resistance, and we just haven't seen that from Home Depot yet.
All right, so let's zoom in on Home Depot then, Kevin, because you highlighted here that back in September is sort of where the downtrend started. Let's zoom in more on that reverse head and shoulders that you were looking at there and what level specifically you're focused on.
Well, now on this 90-day 4-hour look, it actually validates the bit more bearishness, unfortunately. There's my downtrend line with the failures over the last, say, 4 weeks or so at the 200-day. That downtrend line is basically the 200-day moving average. And now what I can't get away from is the fact that we're falling through that line of best fit on the linear regression channel here, and we are looking at potentially support in that 320 zone. So really going back to those same lows that we saw on the daily, essentially the lows since taking that ledge out in mid-June. So very important level at 320, really. If it holds 320, there can be some upside, but under 320, it's not going to be pretty.
All right, Jason, so take us through the trade here. I think based on my quick look here, you've got another bear call spread for us.
Yeah, absolutely. I tell my members that who subscribe to the Brown Report that spreads are your friend right now because there's a lot of volatility in the market. So these stocks could turn around and reverse, but then they end up failing. But that kind of causes this jarring reaction that you may get stopped out. You may hit your I'm wrong level financially and get put out. That's why I like the bear call spread. I'm looking at buying the 370 strike price call. It's going for about 250. I'm looking at the selling the 360 strike price call, which is going for 450. We're talking about August 21st expiration. So only 22 days. The reason I picked that expiration first, well, let me back up. You get a $2 credit. So to risk $10 of capital to get a $2 credit, which means you're getting a potentially 20% return, is a really good risk to reward ratio in that short time frame. The second reason I picked that time frame is because they have earnings coming up on the 18th. So the trade goes about 3 days past earnings. Even if earnings is good, I don't see the stock rallying up and past $360. So this is why I like these trades structured this way. We can go through earnings. Things could be good. They could say the right things. Stock can move up 20, 30 points. We still would be okay. Stock goes sideways leading up to earnings. All that time is getting sucked out, but there still may be a lot more time baked in just because of the earnings event. But after that earnings event happens, all the time is going to get let out, all the air of that trade, which should expire as profit into your pocket as long as the stock stays below 360. So we got 3 ways to win. Stock goes up, as long as it doesn't go up 40, 50 plus points, we're good. Goes sideways, we're golden, and if it falls, we're platinum. So I like this. We keep an I'm wrong level. If there's a big move up, 20, 30 points, we might want to consider shutting it down early, but I don't know why it would do that before earnings. And so assuming we don't get it on earnings, this trade should play out exactly, how we want it to, which should be profit in our pocket. But we'll see.
Yeah, we will see. We will see. As you mentioned, we've got that earnings event on the 18th within this contract, but it would need about a 10% move to get outside of that range. And the last move was about 1% the day after earnings. So that would be atypical for this name. Your last one, a very different chart here. You've brought CSX to us, Jason. We're talking about railroads now. So walk us through CSX.
So I was looking at CSX, and first of all, I know sometimes people look at these $200, $300 stocks, and I get messages sometimes like, can you guys pick something more lower price? I think this is a reasonably priced stock, number one. Number two, it's an S&P 500 stock. And then CSX is just telling us that goods are still moving. Volume increased across the railroad. Their intermodal demand was strong, and profit outpaced their revenue growth. If you look at their numbers, revenue was up 10%. EPS, earnings per share, was up 23%. Operational income was up 17%. Total volume was up 6%. So these are really good numbers. Now, we all know that railroads can lag, so people can stop shipping or reduce the amount of volume and things that they're buying and moving across the country. But right now, the numbers look good. And then from a technical standpoint, as we switch over to the charts, they had a nice pullback to the 10-day and just above the 20-day moving average today. And the stock is in an uptrend. So I like the pullback. It's giving you an opportunity to potentially get in, not at the highs, but at a reasonable price relative to this being a $50 roughly stock.
And Kevin, I'm excited to see the analysis on this one because it is such a different chart than the other two we've looked at. But I mean, as I'm looking out over the last 52 weeks, it looks like the uptrend has been the story pretty much the whole time.
Yeah, I have to agree, Marley. The stock's been fantastic. 37% on a year-to-date basis, pulling back to today, the 20-day. Yes, we're below the 20-day, which is coming in right around $50 a share. That candle, not fantastic, but we are at an area of support. The takeaway that I've got, at least over the last, say, 6 months or so on a year-to-date basis, really, the 50-day seems to be the most important moving average here. We've been under the 20 for a series of closes, twice, 3 times, and have maintained the 50 days. So while the 20-day has been a bit more porous for the trader and maybe puts the onus on them to manage their trade a little bit emotional about the tie to the 20-day, the 50-day has not been violated since late March. So I think that might be the moving average to monitor. That's around $48, only about 4% from where we are here. But ultimately, you're looking at a stock in an uptrend that's simply pulling back from highs.
Let's zoom in, though, onto this 90-day chart, though, and take a closer look at this pullback and what you're seeing specifically.
Yes, very much the same stuff, Marley. Short term, a bit of weakness. Over the last day, 2 days, 3 days, you'll see that we've pushed into 51.25 there a few times. That's the line of best fit once more coming into play. But keep an eye on that blue. It's a 200 period moving average on this 90-day 4-hour chart for CSX. That's just under 49. And that's consistent, again, with that 50-day moving average that we tagged at about 48. So it looks like, from our MACD down below, it's been an aggressive sell down, admittedly. So if you're a patient trader, it's probable that you're looking for maybe a little bit more bleed through and weakness into that $49 level. That'll lead to a potential shift in that MACD, giving you the crossover opportunity in the shorter term.
All right, Jason, so you highlighted the strong numbers. You highlighted that we're still seeing goods moving on the railroads, but you also highlighted some uncertainty as to potential volatility, whether or not freight volumes are going to stay where they are. So as you think about trading CSX, how would you approach that?
So for this one, I like the idea of potentially owning the stock, but I don't want to just go outlay the cash, $50 a share, and then just sit back and wait. So I would look at this as the September 18th, 2026 option. I would sell a covered put, the 5250. It was going for about 250 before the market opened. You may be able to get a better credit than that now that it's down about 87 cents. So depending on if you can get the 250 or a better credit at this moment, you're basically buying it at $50 if the stock gets put to you, which is trading about 13 cents below that right now. You also can see that the stock gapped up over earnings, and now it's kind of coming back to fill that gap. So I want to see if this level holds, or like you said, if it pulls back to the 50-day moving average. But I like that thought of getting a credit, getting paid to buy this. You lower your potential price that you're buying it at, and then you control your capital risk. So if you just decide, you know what, it broke through the 50-day moving average, I don't want to own this, I don't want to be in it, I don't want the stock to get put to me, you could just buy that option back. Cost you, 250 times, depending on how many contracts you buy, but versus putting out $50 a share, I like that as more of a controlled entry into a stock that I believe is going to continue moving up. But if it doesn't, it's easy to cheap to buy it back and take a small loss on this one.
All right, and today's CSX is down about 1.75% right now at 49.86. Really appreciate you both being with us today to take a closer look at these three names for the big three. Jason Brown from thebrownreport.com and Kevin Horner, thanks again for being with us.